Guys, welcome to this episode of Jack's Business Talk. Sarah found us another article. I'm not doing an extra on this one. The only thing I'm going to say is make sure to check the link down below. So, with nothing else to do, here's Sarah.
Hey everyone, thanks for having me on today. Welcome to our comprehensive guide on real estate lending options. Buying real estate can be one of the biggest financial decisions you'll ever make, and understanding how you're going to pay for it is just as important as the purchase itself. Whether you're a first-time homebuyer or a seasoned investor, understanding your financing options is crucial. There are tons of different loan types out there, each with its own terms, conditions, and requirements. Don't worry, we're going to break down the most common real estate loan options you'll come across. We'll go over the pros and cons so you can determine which loan is right for you and your individual circumstances. We'll cover everything from conventional loans to more specialized options like hard money loans and private lending. So, if you're ready to become a real estate loan expert, let's dive right in. First up, we have conventional loans, which are your standard loans that aren't backed by the government. These are super common and are offered by most banks and lenders. With a conventional loan, you'll typically need a down payment of at least 3% to 20% of the purchase price. Now, the bigger your down payment, the lower your interest rate will be, which will save you money over the life of the loan. Keep in mind that conventional loans usually come with stricter credit score requirements compared to government-backed loans. So, if you have a really good credit score, say 740 or higher, you're more likely to snag a lower interest rate. These loans are pretty versatile too. You can use them for a primary residence, a second home, or even an investment property. Next, let's talk about FHA loans. These are insured by the Federal Housing Administration and are specifically designed to help borrowers with lower credit scores or smaller down payments get into a home. One of the best things about FHA loans is that they only require a 3.5% down payment. This can be a lifesaver if you're having trouble coming up with a huge down payment. However, because these loans are riskier for lenders, you'll need to pay mortgage insurance premiums, which will increase your monthly payments. It's also worth noting that FHA loans have strict property appraisal requirements. The property you're looking to buy needs to meet certain standards to qualify for the loan. Now, let's move on to VA loans. These are a fantastic benefit for eligible veterans, active duty military personnel, and certain surviving spouses. If you qualify for a VA loan, you don't need any down payment at all. That's right. You can finance 100% of the purchase price. VA loans also often come with lower interest rates than conventional loans, and you won't have to pay for private mortgage insurance. This can save you a ton of money over the life of your loan. However, it's important to note that there is a funding fee associated with VA loans, but you can typically roll this fee into your loan amount. If you're thinking about buying a home in a rural or suburban area, a USDA loan might be the perfect option for you. These loans are guaranteed by the United States Department of Agriculture and are designed to help low to moderate income borrowers achieve homeownership. Just like VA loans, USDA loans don't require a down payment, which can be a huge advantage. However, there are income limits you have to meet to qualify. These limits vary depending on where you live and the size of your family. USDA loans also come with geographic restrictions, meaning the property you're buying has to be located within a designated eligible area. Now, let's say you're in the market for a more expensive home. That's where jumbo loans come in. These loans are designed for properties that exceed the conforming loan limits set by the Federal Housing Finance Agency. Because jumbo loans are considered riskier for lenders, they usually come with stricter requirements and higher interest rates compared to conforming loans. Expect to make a larger down payment, typically 20% or more, and have a stellar credit score to qualify. Jumbo loans are often used for luxury homes, high-end condos, or properties in competitive real estate markets. Moving on to bridge loans. These are short-term loans designed to help you bridge the gap when you're buying a new home before selling your current one. Let's say you found your dream home, but you haven't sold your existing property yet. A bridge loan can give you the funds you need to make a down payment and close on your new home while you wait for your current home to sell. Keep in mind that bridge loans come with higher interest rates compared to traditional mortgages. They're also typically very short-term, usually around 6 to 12 months, and you'll need to have enough equity in your current home to qualify. Now let's talk about home equity loans. These loans allow you to borrow against the equity you've built up in your home. Equity is the difference between what your home is worth and what you still owe on your mortgage. Think of a home equity loan as a second mortgage. You'll receive a lump sum of cash that you can use for anything you want, like home renovations, debt consolidation, or even investing. Home equity loans typically have fixed interest rates and set repayment terms, just like a traditional mortgage. However, keep in mind that you're using your home as collateral, so if you default on the loan, you could risk losing your home. Similar to home equity loans, a home equity line of credit, or HELOC, also lets you tap into your home's equity. However, instead of receiving a lump sum of cash, you get a revolving line of credit that you can borrow from as needed. Think of it like a credit card, but it's secured by your home. You can use your HELOC for home improvements, unexpected expenses, or even to supplement your income. HELOCs usually have a draw period where you can borrow money and make interest-only payments. After the draw period ends, you'll enter the repayment period, where you'll start making principal and interest payments. If you're planning on building your dream home, a construction loan can help you finance the project. These loans are specifically designed to cover the costs of construction, from buying the land to the final inspection. Keep in mind that construction loans are short-term loans, typically lasting 12 to 24 months, and they usually have higher interest rates compared to traditional mortgages. You'll also need to make interest-only payments during the construction phase. Once the construction is complete, you'll need to refinance into a permanent mortgage or pay off the loan in full. Now, let's talk about interest-only loans. These loans might sound tempting because they offer lower monthly payments for a set period, typically 5 to 10 years. However, it's crucial to understand the risks involved. During the interest-only period, you're only paying the interest on the loan, not the principal. This means your monthly payments will be lower, but you won't be building any equity in your home. After the interest-only period ends, the loan will reset, and your monthly payments will significantly increase because you'll start paying back both principal and interest. Next up, we have hard money loans. These are short-term loans secured by real estate and are often used by real estate investors to finance flips or other investment properties. Hard money loans are typically provided by private lenders or companies, not traditional banks. They can be a good option if you need quick funding, have bad credit, or don't qualify for a traditional mortgage. However, keep in mind that hard money loans come with much higher interest rates and fees compared to conventional loans. They're also much riskier because if you default on the loan, you could lose the property. Now, let's talk about portfolio loans. These are loans that lenders keep in their own portfolio rather than selling them on the secondary market. Portfolio lenders have more flexibility when it comes to underwriting guidelines, which means they can consider borrowers with unique financial situations or properties that might not qualify for a traditional mortgage. For example, if you're self-employed or have a less than perfect credit history, a portfolio lender might be willing to work with you. However, this flexibility often comes at a cost. Portfolio loans typically have higher interest rates and fees compared to conforming loans. If you're looking to purchase or refinance commercial real estate, like office buildings, retail space, or apartment complexes, you'll need a commercial real estate loan. These loans are specifically designed for business purposes and have different terms and conditions compared to residential mortgages. Commercial real estate loans typically require larger down payments, have shorter repayment terms, and come with higher interest rates than residential loans. You'll also need to provide detailed financial information about your business, such as income statements, balance sheets, and tax returns. In some cases, you might be able to get financing directly from the seller of the property. This is known as seller financing. With seller financing, the seller acts as the lender, and you make payments to them directly. This can be a good option if you're having trouble qualifying for a traditional mortgage, or if you're looking for more flexible terms. However, it's important to have a legally binding contract in place that outlines all the terms of the loan, including the interest rate, repayment schedule, and consequences of default. Finally, let's discuss private money loans. These loans are funded by private individuals or companies, not traditional lenders, and are often used for real estate investments. Private money loans can be a good option if you need quick funding, have a unique property, or don't meet the requirements for a conventional loan. However, they typically come with higher interest rates and shorter repayment terms. It's crucial to thoroughly vet any private money lender and understand the terms of the loan before you sign on the dotted line. Thanks for watching. We hope this guide helps you navigate the complex world of real estate lending. Remember, choosing the right loan is crucial whether you're buying your first home or adding to your investment portfolio. Be sure to do your research, compare different loan options, and consider your individual financial situation before making a decision. Don't forget to like, subscribe, and hit the notification bell for more insightful content. And be sure to check out the links in the description below for additional resources on real estate financing. Until next time, best of luck in your real estate journey.